Walter Schloss didn't own a computer. He didn't visit companies. He didn't even have his own office, he sublet a corner from another firm. And for 47 years, he quietly beat almost every hedge fund manager on the planet. If you asked the average investor to name the greatest value investors of all time, you'd hear Buffett, Munger, maybe Peter Lynch. But there's a name most people have never heard, and Warren Buffett himself called him one of the best investors who ever lived. His name was Walter Schloss. And what he did, from 1955 to 2002, rewrites everything you think you need to succeed in the market. Stick with me, because the last lesson is the one that'll change how you invest forever. Walter Schloss was born in 1916. He never went to college. He took night classes at the New York Stock Exchange Institute, taught by a man named Benjamin Graham. You might know Graham as the father of value investing, and as the mentor to a young Warren Buffett. In 1955, Schloss left Graham's firm and started his own partnership with $100,000 from 19 investors. He set up shop inside the offices of Tweedy, Brown, a little corner with a filing cabinet and a desk. That was it. No Bloomberg terminal. No team of analysts. No meetings with CEOs. Schloss didn't even call the companies he owned. He said, and I'm paraphrasing here, management always tells you what they want you to hear. So why bother? What he did have was a single tool: the Value Line Investment Survey, a weekly publication listing thousands of stocks with basic financial data. He'd flip through the pages, looking for companies trading below their book value, below what the business was worth if you shut it down tomorrow and sold the furniture. That's it. That was the entire strategy. And here's where it gets really interesting. From 1955 to 2002, 47 years, Schloss compounded money at roughly 15.3% per year after his fees. The S&P 500 over that same period? About 10%. That gap sounds small. It isn't. $1,000 invested with Schloss at the start would have grown to roughly $763,000. The same thousand in the index? Around 99,000. He didn't just beat the market. He left it in the dust. For nearly half a century. In 1984, Warren Buffett gave a famous speech at Columbia Business School. It was called The Superinvestors of Graham-and-Doddsville. Buffett laid out 9 investors who'd crushed the market using Graham's principles. Schloss was one of them. Buffett described him as a man with no staff, no connections, and no edge, except for the most important edge of all: discipline. So how did he do it? That brings us to the most important part of this story. Schloss typically held around 100 stocks at a time. Sometimes more. That's heresy to a lot of investors today. Buffett famously said diversification is protection against ignorance. But Schloss? He embraced it. Why? Because he didn't trust himself to know which cheap stock would work out. So he bought a lot of them. And let the math do the work. He'd buy a company at, say, 60 cents on the dollar of its book value. He'd hold it for roughly 4 years. When it traded back up to fair value, he'd sell. Then he'd find another one. Rinse. Repeat. He didn't care about earnings forecasts. He didn't care about interest rates. He didn't care what Alan Greenspan said on TV. He once told an interviewer, "I just like to buy stocks when they're cheap and sell them when they're not." That's it. That's the whole philosophy. In 1973, his son Edwin joined the firm. Still just the two of them. Father and son. Through the oil crisis of the 70s. The 1987 crash. The savings and loan mess. The dot-com bubble. They didn't chase any of it. And they didn't get wrecked by any of it either. But the most remarkable thing about Walter Schloss isn't his returns. It's when he decided to stop. By the year 2000, the market was a fever dream. Tech stocks trading at hundreds of times earnings. Companies with no profits worth more than General Motors. Schloss looked around and couldn't find anything cheap. So in 2002, at age 87, he closed his firm, returned the money to his investors, and walked away. Think about that for a second. 47 years of success. And he had the discipline to stop when his method no longer worked in that moment. He didn't adapt. He didn't pivot into growth stocks. He didn't chase the hot thing. He just went home. Walter Schloss lived to be 95. He died in 2012. One of the quietest, most successful investors who ever lived. Buffett wrote him a public tribute. Called him a hero. Here's the thing most people miss about his story. Schloss never tried to be brilliant. He never tried to predict the future. He never tried to beat anyone at their own game. He just kept doing the simple thing. For 50 years. Here's the lesson Walter Schloss leaves us with. You don't need a computer. You don't need a team. You don't need to be the smartest person in the room. You need a simple process that works and the patience to run it for decades. Most investors lose not because their ideas are wrong. They lose because they can't sit still. Schloss could sit still. He bought cheap stocks. He held them. He sold them. And he did it again. 47 years of boring. That was his secret. There was no secret. Simplicity, repeated for decades, beats brilliance repeated for months. So here's my question for you. If you could pick one stock today and hold it untouched for 10 years, what would it be? Drop it in the comments. I read every one. And if this story changed how you think about investing, hit subscribe. Tomorrow, we're looking at a Wall Street legend who made his fortune doing the opposite of everyone else on this channel. You won't want to miss it. This is educational content, not financial advice. Always do your own research.